The gold market just crossed a line it rarely crosses, and the people paid to keep it orderly are suddenly speaking in whispers, because the price isn't the story anymore, the plumbing is. And if you catch the plumbing signal early, you'll know what happens next week before the headline traders even open their apps. Gold has been hovering around the mid-4400s after ripping into late December and tagging a fresh record near $4,550, and that alone tells you something simple. This is not a sleepy drift higher. This is a high volatility regime where every dip becomes a stress test and every breakout becomes a margin conversation. And right when the crowd thinks the only question is $5,000 when, the real conflict shows up. The paper market can print infinite claims, but the physical market can only move bars at the speed of logistics, vault rules, and balance sheets. That's where the real pressure starts. Now, the title you clicked on is a perfect snapshot of how markets mislead people. HSBC silent, Barclays reversed bullish, London Gold Vault 89% depletion. That sounds like a thriller. But the way you actually make money, or at least avoid getting emotionally harvested, is by translating those phrases into mechanisms. Because the banks aren't gods, and they aren't cartoon villains. They're risk managers sitting between clients, exchanges, vaults, and regulators. When their tone shifts, it's rarely because they changed their mind. It's because the trade moved into a zone where the math changes. And when a vault headline screams depletion, it's rarely the total stock that matters. It's the float. The usable, mobilizable, deliverable float. The metal that can actually move when someone needs it this week, not technically owned metal that's locked behind someone else's mandate. And that hidden detail, float versus total, is the entire story. Because if the float tightens, the market doesn't gradually adjust. It snaps. But that's not the part that matters. Here's the clean way to read what's going on right now without falling for the usual traps. Start with the price context because price is still the referee. Gold is not inching higher. It's holding a high plateau after a year where it delivered a once-in-a-generation move. That changes behavior. At $1,900, you can afford to be casual. At $4,400, every participant is forced to tighten risk controls. Dealers widen spreads, funds reduce tolerance for drawdowns. Producers and refiners adjust hedging because the notional exposure is massive. And most important, when price runs that far, fast, the market becomes sensitive to positioning and hedging flows, not just fundamentals. In other words, the next push higher can come from forced buying, not fresh optimism. And forced buying is never polite. Now bring in the institutional messaging. When a bank publishes a bullish target and the market starts leaning into it, that's not just research, it's an ecosystem. Clients trade around those levels. Options get written around those levels. Structured products get built around those levels. And once price gets close enough to touch the research, the incentive flips. Not because the bank hates you, because the bank is now exposed to the very crowd it influenced. The same crowd that will blame them if price reverses. So you often see something that looks like a reversal in tone. The target stays high, but the framing becomes cautious. The words change from upside to range, from strong demand to volatility risk, from bull case to correction possible. And if you know how to listen, and that shift isn't bearish, it's a tell that the market is entering a zone where the next move will be violent, not smooth. The next detail is what flips the whole setup, because the real battle is not happening in a charting app. It's happening in settlement and sourcing. London is the core of the global OTC gold market, and that confuses people because they imagine London like a single warehouse with a single inventory number. It isn't. London is a system, commercial vaults, custodians, clearing members, and the Bank of England's custody operations, all stitched together by rules on bar specifications, allocation status, and who can pledge what to whom. The published totals people love to cite are real, but they're a blunt instrument. They include metal that is not available to settle a short-notice demand spike. They include metal that is sitting there as someone's long-term reserve. Metal that is earmarked, metal that is part of an ETF or custody arrangement where moving it is slow, expensive, or simply not allowed. So when someone screams 89% depletion, you should immediately translate that into a smarter question. Depletion of what exactly? Total holdings? Or available float? Deliverable pool? Lendable supply? Because those are different universes. And if you miss that distinction, you'll either panic too early or get complacent right when scarcity risk peaks. Let me give you the hidden detail in plain language. The gold you can count is not the gold you can get. Total vault holdings can be large and even rising, while the slice of metal that can actually be mobilized at short notice shrinks to a dangerous level. That Gaokong is how you get plenty of inventory out on paper while the market behaves like it while short. And when the mobilizable slice shrinks, you don't see it first in the spot price. You see it first in the financing market. You see it in lease rates. You see it in the forward curve. You see it in the little spreads and premiums that most people ignore because they cannot count out the price. But those are the seismographs. And when they start shaking, that's when you pay attention, because if this one level breaks, the math changes. So what are the stress signals you should care about right now? First, borrowing. When gold is abundant, borrowing it is cheap. When gold gets tight in the right places, borrowing costs jump, and the market suddenly starts paying up for immediate access. That is not a conspiracy, that's inventory management. If refiners, fabricators, or bullion banks need metal to meet obligations, and the easy sources are encumbered, the marginal bar becomes expensive. Lease rates are one of the cleanest tells because they reflect the urgency of sourcing. You can argue about narratives all day. You can't argue with someone paying up for metal right now, and that's where the real pressure starts. Second, venue dislocation. There's a reason serious metals traders watch the relationship between New York futures and London spot ties forwards. In calm times, arbitrage keeps them in line. If New York is rich, you sell New York and buy London, finance the metal, maybe move it, and you lock a spread. If London is rich, you do the reverse. But arbitrage is not magic. It requires balance sheet, credit lines, and the ability to source bars that meet specifications. When dislocations persist, it's a signal that paper can't instantly become physical at the expected cost. And the moment that happens, the market can get reflexive. Dislocation triggers hedging, hedging triggers demand for metal tightens the float tightness widens dislocation further. That loop is how you get sudden vertical moves that feel like manipulation to retail eyes, but are often just plumbing under stress. But that's not the part that matters. Third, the curve. People love to debate spot, but the term structure is where the truth leaks out. In metals, a curve that changes shape, where near-term access becomes more expensive relative to later delivery, can signal tightness, financing stress, or a scramble for immediate settlement. It doesn't guarantee a moonshot. It does tell you something about who is being forced to do what and when. When near-term is bid, shorts feel pain faster. When rolling positions becomes expensive or uncertain, funds that usually just roll are suddenly forced to reduce exposure or pay up. Either way, the curve is a map of stress. Fourth, the real-world symptom layer. If you hear persistent chatter about longer settlement times, about specific bar sizes being preferred, about unexpected premiums in certain regions, about we can get it, but not quickly, that matters more than 1,000 hot takes. Because physical markets move through bottlenecks, refining capacity, logistics, vault throughput, and compliance. Gold is globally fungible in theory, but in practice, it's a chain of yes, but. Yes, the gold exists. But is it in the right bar form? Yes, it can be converted. But how long does it take and what does it cost? Yes, it can be shipped. But who is willing to insure and finance that at scale this week? Those frictions are invisible until they're suddenly visible in price behavior. The next detail is what flips the whole setup. Now let S address the headline contradiction that confuses people. If London Vault data shows big totals, how can anyone talk about depletion? This is exactly why the float concept matters. Picture the total as a lake. The float is the water that can actually reach the outlet when demand spikes. If most of the lake is behind dams, ETFs, long-term custody, central bank holdings, or metal pledged against other obligations, then the outlet can run dry even while the lake looks full from above. That's not a metaphor to make you feel good. That's how market stress works. And this is where the HSBC silent angle becomes useful. It's not that a bank doesn't have an opinion. It's that the most market-moving parts of the story often sit in the unsexy plumbing, lease rates, spreads, curve shape, and delivery behavior, while public forecasts focus on macro drivers and broad price ranges. Those forecasts matter. They also leave out the tactical trigger, and the tactical trigger is what determines whether next week is a controlled retest or continuation squeeze. So let's talk about the why now calendar trigger, because time is the catalyst the crowd always ignores until it's too late. Options expiration and delivery windows create predictable pressure points. Dealers hedge options exposure dynamically. Funds rebalance. Some participants roll futures. Others take delivery or avoid it. And when the market is already in a high vol regime, those calendar events don't just add noise, they concentrate flows. That SYU, I'll often see a market behave weirdly around expiries, sharp squeezes through strikes, sudden reversals, clean-looking breakouts that fail, or ugly sell-offs that get bought back with frightening speed. It's not magic, it's hedging and risk limits hitting at the same time, and that's where the real pressure starts. Here's the mechanism you need to understand to stop getting whipsawed: delta, hedging, and gamma dynamics. If you don't trade options, you still live in an options world because dealers do. When lots of call options sit at certain strike prices, dealers who sold those calls often hedge by buying futures as price rises and selling as price falls, depending on whether they're in a positive or negative gamma regime. In a negative gamma environment, the dealer's hedge can amplify the move. Price rises, they buy more, which pushes price higher, which forces more buying. Price falls, they sell more, which pushes price lower. That's the accelerator. In a positive gamma environment, hedging dampens moves. They sell into strength and buy into weakness. The market feels calmer. Right now, gold is behaving like a market that can flip between these modes quickly, which is why you see bursts and snapbacks. And if the market is simultaneously dealing with physical tightness signals, those bursts can become more than just options noise. They can become price discovery events. Because if dealers are forced buyers while shorts are forced covers and physical is tight, the squeeze doesn't need a new narrative. It needs math. This move isn't emotion, it's math. And there's a second forced buyer channel that people underestimate: margin and short covering mechanics. In a leveraged futures market, you don't have to be wrong to be forced out. You just have to be undercapitalized at the wrong moment. If gold pushes higher quickly, shorts face variation margin calls. Some can meet them, some reduce exposure, some get liquidated. That liquidation is buying, it adds fuel. Then price gaps, liquidity thins, and even strong hands start hedging to survive the volatility. That hedging can itself create buying pressure. The reflexive loop isn't a conspiracy. It's a predictable feature of leveraged markets when liquidity thins and volatility rises. But that's not the part that matters. So now we stack proof the way a serious macro metals investor does, not the way a headline trader does. Proof point 1 is the price behavior itself. Gold is not acting like a slow macro hedge. It's acting like a stressed asset with episodic surges and fast pullbacks. Proof point 2 is the bank messaging structure. Bullish targets paired with explicit warnings of correction and wide trading ranges. That S an admission of volatility, not a denial. Proof point 3 is the plumbing lens, the distinction between total vault holdings and mobilizable float, which explains how lots of gold exists, can coexist with gold is hard to source right now. Proof point 4 is the financing and spread complex. When borrowing costs and venue dislocations become a talking point, that's usually because the marginal bar is no longer frictionless. Proof point 5 is the calendar. Options and delivery windows compress hedging flows, and in a high vol regime, those flows can drive price more than fresh fundamental news. Proof point 6, the one most people skip, is the supply chain reality. You cannot turn demand into bars instantly. Even in gold, where above ground stock is large, the ability to mobilize and refine into the right form at the right location is constrained by capacity and time. Those are not opinions, those are constraints. And constraints are what create squeezes. Now, what about Barclays reversed bullish? Even if you never read the note, you can understand the incentive. When price runs hard and public excitement peaks, the most responsible thing a bank can do, purely as risk messaging, is to emphasize the downside paths. That doesn't mean they're secretly bearish. It means they know the next leg will be fought in the volatility. And volatility is where retail gets emotionally farmed, which is why we need the psychology shield right now, not later. Because here's how volatility manipulates you. It uses the same thesis against you. If you're bullish gold, it will rip higher without you, so you panic by the top. Then it will dump hard, so you panic sell the bottom. Then it will recover so fast you feel stupid and chase again. That cycle is not accidental. It is a feature of markets where liquidity providers and large participants understand where stops cluster and where emotional decisions concentrate, especially around expiries and major levels. And in a high vol regime, even if your thesis is correct, price can whip around violently. That's not a warning to scare you, it's a warning to keep you alive. Trend signal and noise are not the same thing. Trend signal is the market holding higher floors after pullbacks, reclaiming key levels and showing persistent demand on dips. Noise is the intraday violence around strikes, stops, and liquidity gaps. If you treat noise like signal, you'll sabotage yourself. That's where the real pressure starts. So let us get tactical. What are the levels that matter this week and into the next one or two? Not because lines on a chart are magic, but because levels are where positioning flips and hedging flows accelerate. The obvious reference is the late December peak near the mid $4,500. That's your high water mark. If price pushes back toward that zone and holds above the mid 4,400s instead of rejecting, you're telling the market buyers are not just chasing, they're defending. That's a strong signal. The mid 4,400s area itself is a battlefield because it's psychologically roundish, it's close to recent spot reference points, and it's where a lot of short-term hedging will sit. Below that, the low to mid $4,300 becomes the prove it area. If gold can retest down there, hold, and then reclaim higher levels, that's a healthy pullback scenario. If it slices through with speed and you see liquidity gaps, that's when you're in the squeeze and snapback environment where the market is hunting leverage. And if you see a deeper drop toward the low 4,200s or high $40 100s, the question becomes whether the pullback is macro-driven, rates, dollar, de-escalation headlines, or whether it's simply expiry-driven positioning resetting. The way you tell is not by reading Twitter. You tell by watching how price reacts after the initial flush. Does it get bought quickly, or does it grind lower with no bounce? That reaction tells you who is forced and who is opportunistic. The next detail is what flips the whole setup. Now we lay out the two scenario lens, because credibility means you can see both roads before the market forces you onto one. Scenario 1 is the controlled pullback and retest. In that path, gold backs off, maybe sharply, but it finds support. Volatility compresses, and it builds a higher base. That base becomes the launch pad for the next push. In this scenario, the plumbing stress doesn't disappear, it cools. Lease rates and spreads calm a bit, the curve normalizes. Dealers shift back toward a stabilizing gamma posture, and the market sets up the next move with less headline drama. The confirmation is simple. Pullbacks get absorbed, reclaim levels hold, and volatility spikes fade instead of cascading. Scenario 2 is the continuation squeeze. In that path, gold doesn't give you the clean retest. It grinds higher, then suddenly gaps. Liquidity thins, shorts get nervous, dealers chase hedges. Physical tightness narratives get louder because they become convenient explanations for what is actually a mechanical move. And the danger in scenario 2 is not just upside opportunity, it's gap risk and snapback risk. Squeezes don't end with a polite top. They end when the last forced buyer finishes buying, and then price can drop faster than it rose. The confirmation for scenario 2 is also simple. Repeated impulsive pushes through resistance, shallow pullbacks that get bought immediately, and stress signals in the plumbing refusing to normalize. Either way, the playbook is not predict, it's observe and adapt. Because if this one level breaks, the math changes. And now we finally answer the question you actually care about. What comes next, specifically in the next week or two? Here's your checklist, and it's designed to keep you from being emotionally farmed. Not because they change gold's long-term role, but because they can trigger the violent pullbacks that shake weak hands. That's where the real pressure starts. Now, we also need to be honest about what would weaken or invalidate the thesis, because that's how you build trust with yourself. If geopolitical tension cools materially and risk assets stabilize, safe haven urgency can fade and gold can correct even while the longer-term case remains intact. If real yields rise and the dollar strengthens aggressively, gold can face headwinds, especially in the short run when positioning is crowded. If the plumbing stress signals normalize, borrowing costs calm, dislocations compress smoothly, the curve looks relaxed, that reduces the probability of an imminent squeeze. And if price loses key support zones and fails to reclaim them on rebounds, that tells you the market is transitioning from buy the dip to kind of sell the rip, at least temporarily. None of this means gold is done. It means your time frame matters and your risk management has to match the regime. High vol regimes punish stubbornness. They reward process. And this is the part most people miss. In a market like this, the institutions don't have to manipulate anything for you to feel manipulated. Volatility itself is the weapon. It uses your emotions, your time horizon, your leverage, and your need for certainty. That's why the right mindset is not, I must be right. It's, I must not be forced. If you're positioned in a way where a normal pullback destroys you, your thesis doesn't matter. You'll be forced out before the thesis plays out. The market loves forcing people out right before the move continues, because that's how liquidity is found. So the psychology shield is simple. Separate signal from noise, define invalidation levels before the candle, and avoid emotional position sizing. You don't need to win every tick. You need to survive the regime. So where does that leave the HSBC silent and the bank narrative angle? It leaves you with a mature interpretation. Public forecasts talk about price paths and macro drivers, but the near-term battlefield is plumbing plus calendar. A bank can say $5,000 is possible, and corrections are likely in the same breath because both are true in a high-vol regime. What's more important than the quote is the structure. Wide ranges, high volatility, and stress-sensitive catalysts. The market is telling you to expect whipsaws. And if you're expecting whipsaws, you stop being surprised by them. Surprise is what causes panic decisions. Process is what prevents them. That's where the real pressure starts. Now, let's close this the right way. Targets, invalidation, and the next week checklist, without pretending we can see the future. Upside targets are not single numbers, they're zones. The prior high near the mid-4500s is the first zone. A clean hold above it shifts the market's imagination toward the psychological $5,000 handle, and the reason that handle matters isn't magic, it's positioning. It's where option strikes cluster, where structured products get referenced, where headlines reinforce momentum, and where shorts start making career decisions. But you don't need to worship the handle. You need to watch how the market behaves as it approaches it.